All right, welcome back, everybody, to the second episode of the Point. I'm just gonna, you know what? Dagnabbit! Welcome back to the second episode of the CoinFlix Vodcast, as we're calling it. And we are today talking about the investment in cryptocurrency versus involvement in cryptocurrency.
Right, and they're pretty different.
They're very different, right?
Okay.
Yeah, so if you're investing, you're basically looking at either swing trading, buy the dip, sell the peak, which most of us are probably terrible at.
Yeah, that's why I didn't get into that.
Yeah.
Swing trading, I mean, that's like, you have to really, it's almost a full-time job.
Yeah, you have to be a psychic. First of all,
psychic, that would help. But you also got to be sitting there watching, right? And kind of predicting when is this going to dip and when's it going to skyrocket so I can get in and out. Most people don't, well, I don't want to say most people, I don't have the time for that.
No.
Have you tried that? Were you successful at it?
Not a tremendous amount with tokens. The stock market,
yeah.
But like,
you told me, and you actually did pretty well from what I recall.
Yeah, and swing trading with options also puts that into like hyperdrive. So you can do kind of exceedingly well with some smaller trades and fewer and farther between. Cryptocurrency is already as volatile as trading options anyway.
Sure.
Just by itself.
Yeah.
I can't fathom doing something like a 3 or 5 or 10x leverage on cryptocurrency, but people do it, which is crazy. There are tools for it.
That's crazy.
Yeah. And they lose their hats, of course.
Yeah. Because
you do.
So but you've tried to, you said you have or have not tried doing swing trading on?
No. Oh, swing trading. Yeah. Swing trading, like cheap, right? Buying in cheap, selling it, when it moves up. I'm not, back and forth. There are a few small cap coins that I have managed to do that with that ended up being rug pulls. I actually kind of got out of them in time.
And a rug pull is?
A rug pull is when an early investor buys up much of the liquidity of the token, or the people who create the token secretly have a bunch over here that as soon as it reaches a value, they just dump it into the pool, take all the cash, and leave.
All the token holders then are left with pretty much nothing.
With nothing,
worthless currency.
Yeah, they're left with their cryptocurrency that is now worth nothing. Yeah, so it's a frustrating situation to be in.
Is that what the SEC is trying? I mean, because did the crypto community embrace regulation, or is it kind of split where they're like, we don't want to be regulated?
Because, the crypto community fully hates regulation.
But wouldn't that help some of these guys creating false coins that then take your money and just run?
Yes, but there's already kind of a similar, thing in the stock market with the whole hedge fund short selling fiasco that people are dealing with, right? So the regulation isn't necessarily a solution to this. It just creates more of a formal channel through which a similar thing to happen. So you're
saying the whole world's corrupt and there's no way of getting it back to neutral?
It can be. I think that when you look at decentralization,
so is this glass half full or half empty?
That glass is deliciously containing Red Bull.
Fair enough.
Yeah, but I think that you can't avoid whales, right? People with tons of money coming in and manipulating prices and then taking off when things go up in value.
Yeah,
you can't avoid that, and you can't avoid people making like nonsense tokens that don't mean anything. This happens in the stock market too. People make nonsense companies, a shell company that comes up, has a bunch of promises. They do an initial public offering, and then they sell a shitload of stock, and they just close up shop. That happens. It happens in the stock market. That's the most regulated place, right?
Yeah, that's crazy. And there's nothing you can do to prevent as someone buying that. Unless you do your research and try to get to the grassroots of it all. Yeah,
and anyone any stock professional would say, well, obviously don't invest in those. Don't put all your money on that. Just always invest in blue chip stocks. Okay, cool. Always invest in blue chip base blockchain coins.
Bitcoin, Ethereum, right?
Ethereum.
Yeah, but then you miss out on some of those like Doge. I mean, people made a ton of money on Doge.
And same thing with these, with these nonsense IPO stocks. Some of them go up, 400% within the first month, and then they just turn to zero because they just, company goes bankrupt. Well, whatever. So it happens.
It's the risk of investing.
Yeah, and I think that you can't avoid the shady stuff, right? I think that what's interesting about the blockchain is that by nature of the decentralized aspect of it, while you can't have the kind of regulation and control and enforcement and easy to send people to jail, not that we send anyone to jail over stock fraud, but historically speaking, 2008 is calling. Basically what it like all of the stuff, even though it's anonymous for the most part, right? It's all publicly traded. It is truly public. You can follow every transaction on the blockchain, every single transaction, every single wallet. You can follow that publicly,
and that's the beauty of blockchain technology.
Yeah, I mean, right now we don't know who all is buying and selling, S&P 500. We don't know who all is buying and selling, AMC,
because those transactions are not public.
They're not public.
But the blockchain holds everyone's transactions, though it's just
no matter how small.
No matter how small, it's just a hash number, like one blah 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 blah. However, it's there.
Yeah. The only way you have to register, the only time you know who's holding a stock is if they're holding 5% or more, and they're legally required to register that publicly. But other than that, anything under than 5% total ownership of the company. It's totally anonymous.
Well, how come the stock market hasn't gone to blockchain recording?
There are a lot of theories behind that. One of which is
because
that
the corrupt can't corrupt.
Yes. One of the theories behind that is because short selling, which is actually at its core, how like communism is good on paper. Short selling is actually a function of market liquidity that keeps the market from locking up.
Okay.
And keeps prices from suddenly going to $1 billion for no particular reason because of some supply and demand issue. Mm-hmm. So like short selling at its core on paper does provide a liquidity function for the market.
Okay.
And those T+2, T+7, T+14, 21 day like failure to deliver and delays and stuff for trades to go through in the market.
Okay.
Those things allow time for that stuff to sort of like fall into place and the whatever the dominoes to fall into place, right? So. The problem is when those systems are used to create manipulation and stuff, like instead of being a bunch of dominoes, it's a house of cards we're waiting to fall. Mm-hmm. And I think that a lot of people think that if we moved the stock market onto the blockchain, that it would resolve that, and you wouldn't even need short sellers, you wouldn't need market makers, you wouldn't need any number of these entities that are providing liquidity, because it would all be run automatically by what are currently liquidity pools doing this by itself. But I think the whole market would become very volatile very fast if there was no padding, if there was nothing to slow down the actual action of those trades to the price reflection. I think that we would see a lot of volatility in the market, which realistically is probably like secretly there. It's just slowed down. It's just by delayed. These transactions.
It's interesting. I want everyone to understand that that's a very valid point you just brought up. The reason that cryptocurrency seems to just like a roller coaster ride, literally within minutes, right? This thing's going up and down. You don't see that as much in the stock market because it's more of a delayed reaction, right?
Yeah, there are systems and powers in place that make sure that like when you go to buy a stock at a price, that it's available immediately for you to buy
at that price.
Right? Yeah. Because you, with your interface broker, you aren't waiting for someone to come along and sell you that particular one.
Okay.
Yeah.
But then, so then what if I sell that stock, right? You're saying there's when you say T, you're talking about time,
yeah, and day of trade.
Day of trade. So when I see something on, let's say, the stock on Robinhood at a purchase price, when I hit that transaction, I'm getting it at that purchase price, am I not?
You're getting it at that purchase price at that moment, but that actual share hasn't left its place and gone into your ownership yet. Not for 48 hours.
Not for 48 hours. Yeah. And because of that delay, it keeps the metric scale from just going like this all the time.
Yes. Yeah.
Where cryptocurrency is instantaneous because it's all recorded on the blockchain.
Yeah, because part of the delay that you wait when you buy and sell stuff, you wait for that notification saying, bing, like transaction done, you get a little notification that it went through. Like the information for the purchase or the sale or the transfer gets sent out to the chain, then it has to get validated by the distributed ledger. In the case of Ethereum, by miners, like people using their GPUs
to mine,
which is to say they're actually providing the power, the resources to actually.
And that's usually done within minutes, though, isn't it? About 10 minutes, the average.
Depends.
How many people are mining at the time?
How many people are mining at the time? How many transactions are going through at the time?
What you put your gas fee at?
Yeah, what you put your gas fee at, yeah.
And the people don't know, the gas fee is how much you are willing to pay above what you're trading or selling or buying, for that matter, right?
Right.
It's what you're willing to pay the community who is mining, when we say mining, or writing to or monitoring the blockchain, which, I know you mine.
I do.
Right. And I know that others mine. And part of how you get paid is if I send my cryptocurrency to whomever, I potentially, if you're one of the individuals monitoring the blockchain, you're going to get paid some of that gas fee that I had to spend. $10, $15, whatever. You're going to get a portion of that for making sure that, Evan did send this to so-and-so. And that's now been written up there. And I use my computer, my GPUs to monitor and verify that transaction. That's what a gas fee is.
Yeah, and it incentivizes it because there's no central server, there's no main company that's running this stuff.
It's just a bunch of individuals, isn't it?
A bunch of individuals, right? And so to incentivize every random individual to give their processing power to this network, right? You have to give them something, and
because why would you do it then?
Yeah, exactly.
And plus, it costs you money to buy the machines, to buy the GPUs, the CPUs, the motherboards,
and there's upkeep from electricity too.
You got electricity to run those things, so you need to be compensated. Otherwise, you just keep losing money just monitoring a blockchain for free.
Yeah.
But that's what the beauty of the blockchain is, though. It's monitored by the community. It's by all of us. We keep those transactions monitored. So they are, and I've heard this many times now, the blockchain is hacker proof? Because if someone tries to artificially record a transaction, the other miners will find out this is not a valid transaction, and it gets either flagged or
it's ejected basically.
It's ejected, right? Because you can't bypass all the other people who are verifying that transaction.
And the craziest part to me about the blockchain is that you have this enormous network. It's planet size, right? There's so much. I mean, the silicon shortage and everything, right? Like the amount of processing power that's behind this right now is crazy.
Sure.
So you have all the computers. That's basically our highest collective amount of processing power we've ever had as a planet doing one thing together, right?
Monitoring these blockchains,
right? And so when a transaction goes through, it's like. Someone was explaining that basically, if there was like a crazy solar flare, whoosh, right, they just knocked out half of all the electronics and wiped half of all the hard drives on the planet, right?
Okay.
When electricity came back online and the internet was restored, the different hard drives that have copies of the blockchain and the different mining GPUs that are validating transactions, they would immediately come back up and say, oh, hey, I have the whole blockchain here, because each one has the whole blockchain. Like realistically, each place the blockchain is like copied, it's like you can literally download the entire Bitcoin blockchain by yourself right now on your computer if you wanted to. You could actually literally
of all the transactions,
everything that's ever happened on Bitcoin, you can just download that file. And so like the computers and the processing devices that are basically like monitoring and validating these transactions, they would start springing up, and they'd connect and say, oh, hey, I have the blockchain here. Oh, I have the blockchain here. And they go, oh, yes, our data matches. And the third one pops up. Oh, our data matches. And the fourth one pops up, and this one, before it came online, the person who has this one turned on the machine, hacked the data to give himself 50 extra Bitcoin, and then he released it to the web, and then the other ones go, that doesn't match, and then they just eject it. Or they overwrite it on that machine.
So the blockchain, obviously, when we say the cloud, it's a server. There's no digital information up there roaming around in the atmosphere. It's existing on planet Earth on some hard drive somewhere, right? That's
on
multiple hard drives,
millions and millions of hard drives.
So the blockchain, like as an example, Bitcoin's blockchain, it exists on hard drives of all these people's computers, correct?
Sure.
And they're all sharing that information to each other to verify it.
To simplify as much as we can. Yeah, basically. So, like, if you wiped out half of all the servers on the planet, we would lose a bunch of data forever, right? We would lose a lot of stuff.
That would be a day.
Yes, it would. But as long as there is one machine, or even two, say 3 machines that exist that can validate the data from the blockchain, anywhere on the planet, as soon as they reconnect, the blockchain exists again, and it will revalidate and rebuild. It's crazy. It's wild that, like, the thing that makes it seem so impossible and kind of fake is the very thing that makes it so impossible to break.
Right.
Which is kind of, poetic and a rhyme there, so y'all are welcome for that. But anyway, so being involved, right, is like we talked about the trading side, but being involved is, mining or staking, or there are some blockchain video games that are coming up now that as you play the video game, you're paid in tokens, right?
That's like that's right out of future talk as far as being able to support yourself. What are the things that humans all need? Shelter and food and shelter, right? If you could do that by interacting with a machine, I mean, I guess we're kind of already doing that now.
I mean,
honestly.
just from the mining side, you can have, you could have a machine full of GPUs sitting in the corner of one of the rooms in your house, just running 24/7, making a portion of your rent.
Yeah, I mean, right. I think as the price comes down on GPUs, it seems more feasible. Right now, like one mining rig can cost $15,000.
Yes, it can,
and it can make you maybe $1,000 a month. So at a $15,000 spend to make $1,000 a month, I mean, depending on where you're living in the country, in LA, you're not going to do too well with that.
Electricity is a little expensive, but the crazy thing is, even at current crypto prices, which are obviously near all-time highs, right? But at current crypto prices, when you build a mining rig that's $15,000, even when you factor in electricity costs, 24 months, right?
Yeah.
16 to 24 months to pay it off. And like, if you look at any business venture, 2 years of active, work and spending before your company, your startup is like profitable. Right. That's pretty standard. Right. So like, it's kind of crazy to think of it that way, that like, even at the crazy inflated prices right now, you're still looking at 24 months to like a solid ROI. Yeah. Before, and that is assuming that crypto doesn't increase in value. Right. Right. Assuming it doesn't increase in value or dip and then come back up, or that the difficulty rate doesn't change. Of course, it's very volatile. So those are all crazy assumptions to make, but like,
to the average person, their involvement. Okay, so there's deep involvement. Buying mining rigs, putting them in the corner to write and to monitor blockchains and to or mine new blocks on the blockchain to get rewarded in cryptocurrency. And then there's other ways to be involved besides going that hardcore. Right. It's about staking, and staking is basically putting your crypto away on a exchange somewhere, or basically putting it in storage, as we say,
tying it up somewhere away from where it can be easily sold,
cashed out or traded or whatever. And you're tying it up, and then as it's sitting there, it's gaining an APY. Yes. It's getting either APY in its native form. Yes. So you could take as an example Ethereum for Ethereum 2 and get paid in Ethereum at I think it's at 4% or 5% on Coinbase as an example APY. And then there's other places, and there's some APYs that people will be like, that doesn't even seem real. I know I have some of my crypto staked on PancakeSwap at the 76 or 75% APY, which seems nuts, but it's wild. Working, and I'm watching it collect its own money.
I have one particular meme coin that I have. The one I swing trade sometimes.
Which one's this one?
Sheep. Which can be staked to get Ryoshi's vision or something. There's like basically when you stake Shiba Inu, you don't get more Shiba Inu, you get a different token. Right. Which is like, it's interesting. It's fascinating stuff. And of course, without, you never know what's going to be rug pulled, and these are kind of a game theory thing anyway, but there have been popping up these DAO tokens.
DAO stands for
Decentralized Autonomous Organization.
Decentralized Autonomous Organization.
Yeah. Which like some of these DAO tokens, while at their core all they need to be a DAO, is basically allow you to, say the community votes on what happens. Right. And that's law. That happens.
That has to happen. So if a DAO cryptocurrency says we're going to vote on, let's say, how our smart contract works, if we're going to give X percentage when you buy or sell or trade our currency, 10% goes back to the pool or 5% goes back to us. Sure. The community says no, we're going to vote on even split. That token now has to abide by the community's vote. Yeah. That's the DAO token. So it's basically major changes are controlled by the public's interest.
Yes.
I'm sure that's probably very popular, because that keeps people from doing, the owners of the cryptocurrencies from doing some backward stuff.
Yeah, assuming you can trust them, of course, right? That's with anonymous groups, right? So you can claim it's a DAO, and then as soon as a vote goes against what you would want as the owner, then you're like, we're not a DAO, screw you guys.
you would think then the community would say, well, the hell with you guys, we're going to sell out.
Yeah, it's just a question of, how much does the token increase in value? Do they manage to get rug pulled before that? So like, just a DAO being a DAO doesn't mean that it's enforceably a DAO. It just means that it is by design a DAO.
To be
right?
a DAO.
Yeah. So like CoinFlix could technically be considered a DAO, because what we do is, as we're generating content, we will be taking open votes from the community about like which.
Well, that's part of the beauty of CoinFlix, right? So our cryptocurrency, CoinFlix, is used to make films. Yeah. But those films that we're going to make are voted on by the public, right? Of what we should make. Yeah. And of course, the interest of the public is to determine that would be a bad idea or that would be a good idea to make that film, because if the film is successful, a portion of those proceeds of the success of the film goes back to the wallet holders.
Yeah.
So they're in it to win it.
Yeah.
Because as we make good projects that they're involved with the voting on what we're to make, they get rewarded.
Yeah.
So it's in their interest to make sure they're involved.
Yeah,
which
exactly.
Which is what we're talking about, investment versus involvement.
Right. So even then, it's like not only do we have our transaction fee on CoinFlix, but the involvement in voting on the DAO side of CoinFlix isn't so much that you're just being like, oh, I'm getting 1,000% APY, some crazy number that some of these like experimental projects are doing, but you're saying, I'm voting on a project I think will make the most money, and then that money's going to come back to the token, and that's something that like that's layers of involvement with something like CoinFlix, right? So, even while you're waiting for your investment to increase in value, because we all want these things to increase in value, that's the point, right? They are money, it's cryptocurrency, right? They aren't necessarily securities, right? But while you're waiting for this thing to increase in value, you can actually be involved in either the success of it, or you can be involved in locking up value to keep the sort of the price floor up and be paid in additional tokens for that. Sure. Or you can, do things like stake one and then get a different token entirely, which is odd, but people are trying all sorts of stuff. I
don't understand. I hope people understand really what's going on here. The more friends I talk to who are like, how do I even buy cryptocurrency? This whole time they're trying to figure out how to buy or what to buy. They're missing all this. They're missing all this basically money they could be making if they're staking it, putting it up somewhere. Because I can promise you, your savings account at B of A or Wells Fargo getting 0.02% APY is nothing compared to 8% of my Gemini tokens on BlockFi. I mean, we're talking 0.02 versus 8. Yeah, that's nuts. Right. So part of the reason we're doing all these podcasts is to bring awareness also to the listeners, and not only just the CoinFlix community, but anyone interested of the power of what's going on right now. Yeah. Again, it's that wish I knew about it sooner. For sure. So I guess to summarize, right, there's a significant difference between just being an investor and then getting involved. And when you get involved, you can actually do things like make decisions on the blockchain. You can get staking rewards. You can get percentage yields, things you would never expect to be able to do with your money normally, and ways to be involved in the development of projects in a much closer, more intimate way than you would with just normal stocks and waiting for shareholder voting things to come around. I heard a really great description, which I'll save for our next episode. Okay, which is that explained that. We've now gone into the third iteration of the web, right? So Web 1.0 was kind of the AOL days. Web 2.0 was, initial HTML and stuff where we're at now. Some people could say late stage capitalism. And then Web 3.0 is basically the blockchain. So I'd love to talk about this in the next one, by the way. Which I'm excited to because I still want to learn more about this. We're in Web 2.0 now. We're in 2.0 now. And Web 3.0, the internet, when we say web, is coming. Yes, exactly, yeah. So 2.0 is basically saturated now and controlled by a very small collection of companies. Such as Google, Yahoo. Facebook. Yeah. Right, they really do control the web, let's be honest. Absolutely, yeah. Okay. And we, as members of society, we all know like the glory days of the internet. Remember E-Bombs World and Newgrounds and when YouTube, back when you could see a video of a bunny like sneeze on YouTube and it would get millions and millions of views, before what it is now, right? Like the days of the internet being just an explorative space, that was before there's half a dozen or so, conglomerates basically control the search engine. Whole thing. Sure. Yeah. So now Web 3.0 is giving access to users again to actually take ownership and be involved in that development. Can't wait to talk about it. I'm very excited to talk about that. But we'll save that for next time. On that note, cheers. Thank you, everybody. Cheers. Yeah. Cheers to CoinFlix. And we'll see you soon. See you guys next time.